What is Forex trading? The term Forex is short for foreign exchange market, which is the place where different currencies are exchanged in a continuous fashion by millions of people all over the world. Tourists who travel from one country to another must exchange currencies in order to pay for a local product or service. A wad of euros would be totally useless to an Italian tourist wishing to visit the Sphinx in Egypt because it is not the locally accepted currency. The tourist would have to exchange his euros for the local currency, Egyptian pounds, at the existing exchange rate that day. Even without boarding a plane, residents of one country exchange currencies with another country each time they purchase a foreign product. For example, if you're living in the US and want to buy a nice bottle of French wine, you may pay for it in dollars, but the wine has already been paid for in euros. Somewhere along the line, either the wine producer or the American importer had to have exchanged the equivalent value of US dollars, USD, into euros. Unlike the New York Stock Exchange or other stock markets, there is no central marketplace for foreign exchange. Rather, currency trading is conducted electronically over the counter, OTC, which means that all transactions occur via computer networks between traders around the world, rather than on one centralized exchange. The market is open 24 hours a day, 5.5 days a week. The need to exchange currencies is the primary reason why the Forex market is the largest, most liquid financial market in the world. It outperforms other markets, including the stock market, with an average traded value of around US $2 billion per day. So why would anyone trade Forex? Ask 3 different people and you will get more than 3 different answers. Of course, right off the bat, making money is the most frequently cited reason, and this is a perfectly legitimate motivation. We all live in a world where money, even if it can't buy everything, can certainly still make life a lot more enjoyable. There are some people who trade in the Forex market because they see it as a form of gambling and betting on the winning number. It really can be a lot of fun, especially if you win. And there are others who trade Forex just for the personal satisfaction of making a trading system work for them and coming out with the results they aimed for. We are always satisfied when we make the right choice and come home the winner. You see, the common factor for why people trade Forex is quite simple. One way or another, these people are getting whatever it is they want: money, enjoyment, or self-satisfaction. Or perhaps they are trading for all 3 reasons. Forex trading is really a very simple concept. When you move along in our lessons, you will see that Forex trading differs from other means of accomplishing your goals in that it offers opportunities for success in ways that are unmatched by other activities. In our next lesson, you will learn these differences and will learn to understand exactly what is traded on the Forex markets. Stay tuned. Why trade Forex? Part 1. With the recent popularity of Forex trading, many investors wonder why Forex is the way to go. Here are a few reasons which answer this question. Why Forex? One of the reasons why people trade Forex is diversification. Just as every competent investor needs to diversify by asset classes and sectors, so do they need exposure to assets in multiple currencies and an understanding of Forex trends and what drives them. Why Forex? Certain currencies tend to move with certain commodity prices. Having commodities exposure is a means of hedging this currency risk and playing Forex trends. So both Forex brokers and traders typically also deal with commodities. Thus, while they are different asset classes, in practice, Forex tends to include commodity trading and investing. Why Forex? Forex has higher risk-adjusted returns. Forex is among the most rewarding asset classes for traders and investors. Although Forex has a reputation of being for short-term, high-risk speculators, there are trading styles suitable for both short-term and long-term traders. More conservative active traders use longer-term holding periods and specific methods and instruments to reduce risk. Long-term investors know how to ride stable, proven, long-term Forex trends for capital gains, earn steady income from different kinds of currency trades or from investing in bonds, dividend stocks, and other income vehicles. For those willing and able to handle more risk and understand why Forex has become so easily implemented, the availability of leverage or borrowed funds to control large blocks of currencies allows greater gains and losses. Using leverage creates unmatched profit potential for those with limited trading capital, only if they learn how to control the downside risk. For example, with 100-to-1 leverage, a 1% move means 100% profit. It also means 100% loss. If not for this ability, why trade Forex? If you know how to manage the risk of high leverage, you can grow your principal with leverage far faster than in other markets. And that is why Forex has taken center stage to all other investment vehicles. Why Forex? A Forex trader can profit just as easily in a falling market as in a rising one. During times when markets are in strong downtrends and the easiest profits and least risky trades come by betting that stocks or commodities will go down in price, regulators will impose restrictions that make betting on downtrends harder or impossible. Stock markets will see uptick rules or outright bans on short selling. Commodity markets will raise margin requirements so that such trades are more expensive and less profitable. That can't happen in Forex markets. In every single trade, we're buying one currency and selling another. So it's impossible to ban selling or buying of certain currencies without shutting down the entire Forex market. We'll explain this in greater depth later. For now, just know that in Forex, it doesn't matter if markets are rising or falling. There are always ways to profit regardless of the trend. If you're heavily exposed to a certain kind of asset, you can hedge that position with a currency trade designed to move in the opposite direction.